Breaking news for every HBAR holder, and if you're not holding any yet, this might be the moment you realize you've been standing outside the next major wealth wave. The first HBAR ETF has already eaten through 421 million HBAR, nearly 1% of the entire supply, and they're not slowing down. Institutions are buying while everyday investors panic sell, and the question nobody is asking is the only one that matters. What happens when billions more get locked away? The answer is bigger than anyone expects. If you're interested in this topic, hit the join button, subscribe, and type interested in the comments, and I will give you a heart. If you're holding HBAR right now, you're sitting in the middle of a financial storm that most investors don't even realize has already begun. The numbers people keep repeating, 421 million HBAR accumulated by the Canary Capital ETF, are only the surface level story. What's happening underneath is far more dangerous, far more bullish, and far more irreversible. Because when institutions perform an accumulation this aggressive, this early, and this quietly, it signals one thing. Someone already knows what's coming before the public does. That's why while retail panics, institutions are loading up. Every retail fear sell is instantly absorbed by deep pocket buyers who understand market structure, liquidity pressure, and supply dynamics better than most participants ever will. And this is the part 99% of people miss. ETFs don't trade like retail. ETFs hoard. ETFs lock. ETFs accumulate relentlessly without emotion. And once their assets are under management, they become permanently removed from circulation. That's why that 421 million HBAR is not just a number, it's a warning shot. It means we just watched a newborn ETF swallow nearly 1% of the total supply in under a month. Not a year, not a quarter, a month. Now imagine what happens when more HBAR ETFs go live, because they are coming. Some already filed, some already approved, some already waiting for their launch window, and institutions don't wait for perfect timing. They buy because the long-term infrastructure narrative is already decided. And HBAR isn't being accumulated as a speculative gamble, it's being positioned as the underlying engine for enterprise blockchain, tokenization, real-world assets, AI, trust layers, and cross-vendor settlement infrastructure. That's the entire difference between a hype coin and a backbone asset. Backbone assets don't moon randomly. They rise because utility forces demand, and demand forces supply crunches. And that's the real threat retail doesn't see yet. This supply shock isn't hypothetical, it's already happening in slow motion. Think about it. HBAR has a max supply of 50 billion. Circulating supply sits around 42, 43 billion. But the number that matters is how much will never return to the open market once ETFs, institutions, enterprises, treasuries, and tokenized platforms keep locking more away. Already nearly 1% is sealed off by a single ETF, and Grokk's projection shows more than 578 million HBAR accumulated by year-end and 5.7 billion HBAR, over 11% of supply, by the end of 2026. That doesn't include retail accumulation, enterprise usage, DeFi liquidity locks, staking, tokenized RWA platforms, government adoption, or additional ETF launch. And what happens if 2 or 3 more ETFs launch by mid-2026? Accumulation could double, meaning 10 to 12 billion HBAR could simply vanish into regulated institutional vaults forever. That's nearly a quarter of circulating supply gone before the next bull cycle even peaks. This is why the price action looks boring. Institutions accumulate when the chart looks dull. They buy when sentiment is dead. They buy when retail calls everything a scam, and they buy slowly because they're not chasing price, they're absorbing liquidity. That's what creates supply shocks that feel sudden, even though the buildup was happening the whole time. That's why the next explosive HBAR move won't be caused by hype. It will be caused by math, by scarcity, by automated, scheduled ETF buying pressure that never stops. And here's the psychological trap retailers fall into. They think HBAR at 14 to 15 cents is slow, boring, dead. But when you zoom out, you realize something different. Assets that move slowly before a supply choke are the ones that move fastest after it. Because the moment ETFs cross a certain threshold of locked supply, the market flips. Price stops being controlled by casual traders and starts being controlled by structured capital flows. That's when breakouts happen that no one expects. That's when a move from 15 cents to 40 cents doesn't take 2 years, it takes 2 weeks. We've seen it before. In 2021, HBAR shot from 3 cents to 60 cents. Last year, it ran from 4 cents to 40 cents in a single month, and that was without ETF pressure. Now imagine those same explosive moves with billion-dollar accumulation pipelines behind them. That's why this moment matters, because the boring phase is ending, the accumulation phase is visible, and the supply shock phase is inching closer every single day. The part nobody seems to understand is this. ETF accumulation doesn't follow the same emotional rhythm as retail trading. Retail buys when they feel excited and sells when they feel scared. ETFs buy because they must. If an ETF receives inflows, it buys. If it expands, it buys. If new investors allocate, it buys. In other words, ETF demand is automated pressure. And automated pressure is the most dangerous force in a low liquidity market. This is why the early numbers matter so much. When a brand new ETF without a BlackRock level brand, without a $1 billion marketing engine, quietly absorbs over 421 million HBAR in a few weeks, that says something about where institutional attention is moving. And that's before the others launch. People keep underestimating that part because they're still thinking in the mindset of, well, HBAR is small, why would institutions care? But the actual reality is the opposite. HBAR being smaller is exactly why institutions like it. Bitcoin and Ethereum ETFs barely move the supply needle because their supplies are enormous and their liquidity is deep. HBAR is different. Its liquidity is thinner, the available supply is tighter, and the institutional narrative is sharper. Enterprise adoption, tokenization, AI trust layers, ESG compliance, cross-vendor settlement infrastructure, government partnerships, banking integrations, all backed by a governing council with brands that retail investors dream of seeing in other ecosystems. That's why the ETFs are moving so aggressively. They understand that networks that actually serve enterprise scale use cases are the ones that win the next decade. And HBAR is one of the only assets positioned for that reality. Look at the numbers again through that lens. Grok projects 578 million HBAR accumulated by the end of this year, and that's with conservative modeling. But the moment multiple ETFs begin trading simultaneously, linear accumulation turns exponential because each ETF becomes its own demand engine. Each one locks supply independently, and each one grows its AUM through inflows, reinvestments, rebalancing, and exposure from traditional finance. That's how you go from 578 million to 5.7 billion HBAR in 12 months. And here's the part that should make every holder pause. That projection doesn't account for acceleration. Grok literally says this model does not factor in additional ETF approvals, institutional FOMO, regulatory clarity, inflow surges during bull cycles, or multi-chain tokenization demand. That's why the model suggests supply absorption could double to 10-12 billion HBAR. If even half of that plays out, we're talking about the biggest structural supply removal HBAR has ever seen. And this isn't happening in isolation. It's happening at the same time retail accumulation is rising, developers are expanding, new use cases are launching, and tokenized assets are coming online. Read that again. ETF accumulation is happening while network demand is increasing. This isn't just bullish, it's the recipe for a violent supply squeeze, because once those locked assets hit ETF vaults, they're gone. Retail can't sell them, whales can't manipulate them, exchanges can't lend them out. They become permanently removed from the tradable supply. Meanwhile, demand doesn't disappear, demand compounds. Tokenized real estate platforms need HBAR. Enterprise applications need HBAR. Staking needs HBAR. AI integrity systems need HBAR. DeFi liquidity pools need HBAR. Even government pilots need HBAR. So you have two lines moving in opposite directions, supply crashing downward, demand rising upward, and they will eventually collide. That collision point is what every investor labels the supply shock moment. But by the time it happens, it's too late to accumulate because the phase before the shock feels boring. It feels uncertain. It feels like nothing is happening, even though everything is happening behind the scenes. That's why emotional investors always miss it. They judge the opportunity through the lens of current price action, not future supply dynamics. They look at 14, 15 cents and think stagnation, while institutions look at it and think accumulate before the door closes. And trust me, the door will close. History has already shown that once HBAR gets the right ignition spark, it doesn't move slowly. It erupts. In 2021, it went 3 cents to 60 cents. Last year, it went 4 cents to 40 cents. Those weren't normal moves. Those were glimpses of what happens when supply lines tighten and demand floods in simultaneously. Now add ETF pressure to that formula. Add enterprise adoption, add regulatory clarity, add tokenized real-world assets, add institutional credibility. You get a perfect storm most people won't recognize until it's already too late. And that's exactly why this moment matters. You're watching the quiet part of the cycle, the part where accumulation happens in silence. But when the shock hits, it will be loud enough for the entire crypto market to hear. Here's where everything you've heard so far comes together, because the story isn't just about ETFs, accumulation, or supply mechanics. It's about what happens when the broader ecosystem wakes up at the exact same moment that liquidity begins drying up. Most people still think HBAR's future depends solely on price speculation. They don't understand that the real engine, the one institutions care about, is infrastructure value. The reason major organizations keep choosing Hedera is simple. It solves problems that blockchains can't. And that's not hype. That's why banks, Fortune 500s, governments, AI labs, and payment networks are quietly building on it. That's why enterprise adoption keeps accelerating. That's why developer activity ranks near the top. And that's why the governing council, with names like Google, IBM, Dell, LG, Boeing, Standard Bank, and more, keeps expanding its strategic partnerships. When you look at the ecosystem, the pattern becomes obvious. Every new integration increases demand. When tokenized money market funds run on Hedera, that creates demand. When sustainable energy platforms anchor their verification data on Hedera, that creates demand. When AI systems need verifiable compute and use Hedera's consensus and proofs, that creates demand. When banks like Shinhan push cross-border settlement on Hedera rails, that creates demand. When tokenized real estate platforms like Gcoin bring property ownership onto Hedera, that creates demand. Demand is not hypothetical. It already exists, and it's multiplying faster than retail investors realize. Now, combine that with ETF absorption draining the liquid supply. The moment developers, enterprises, and institutions require more HBAR than the market can provide at current prices, something dramatic happens. The market reprices violently upward, not slowly, not politely, not gently, violently, because scarcity forces acceleration. And that's the part nobody is prepared for. Everyone is conditioned to look at the current price, 14, 15 cents, and assume it means this is where we belong. But the current price is a reflection of what the market knows, not what the market is about to discover. And the market has not priced in ETF drain. It has not priced in enterprise growth. It has not priced in tokenization surges. It has not priced in supply compression. It has not priced in the fact that Hedera's circulating supply doesn't actually reflect the true supply, because large portions are already illiquid in council treasuries, long-term enterprise holdings, staking pools, and locked allocations. What happens when 1% of supply becomes 5%? When 5% becomes 10%? When 10% becomes 12 billion HBAR locked away in ETFs alone? Each percentage removed from circulation increases the sensitivity of price to new demand. That's why HBAR's past pumps were so extreme. Because even without institutions, minor increases in demand triggered massive upside. Now amplify that dynamic with ETF mechanics. Most people forget this. ETFs don't just buy once. They rebalance, they adjust. They follow inflows. They dollar cost average automatically. They accumulate during volatility. They buy when others panic. They restrict supply during sell-offs. This means ETFs accumulate more aggressively when retail is scared, which is exactly what's happening right now. Retail fear equals institutional entry. Retail doubts equal institutional conviction. While normal people are hesitating, ETFs are accumulating hundreds of millions of tokens at a discount, tokens that retail investors will never get back. And here's the brutal truth. Once the shock phase hits, retail investors will be the ones buying from each other at higher prices, while ETFs sit on locked positions they purchased during the quiet accumulation era. That's why the warning matters. Not because HBAR is going to the moon tomorrow, but because the window where accumulation is possible is shrinking every single week. You're not competing with other retail traders anymore. You are competing with institutions, funds, ETFs, and enterprise demand, all of whom have more money, more patience, and more strategic discipline than most individuals. That's why this moment feels slow. That's why the charts look boring. This is what institutional accumulation looks like. It's quiet, it's controlled, it's methodical. And then one day, the market catches up and everything moves at once. Prices snap upward, liquidity dries out, narratives explode, retail FOMO rushes in, and the tokens ETFs bought at 14 cents start getting bid at $1, 0 cents, $2, 0 cents, $5, 0 cents, and eventually far more. This is the cycle. It has happened in every asset class where supply is finite and demand becomes institutional. But this time, you're early enough to see it forming with your own eyes, if you're paying attention. Most won't. They'll wake up later and say, I should have bought more. The people who understand the mechanics, the people like you who actually look beyond price, will be the ones who realize that the moment of hesitation is the moment of opportunity. And right now, the opportunity couldn't be louder.